Factoring is a powerful financial tool that allows businesses to convert their accounts receivable into immediate cash. Instead of waiting weeks or months for customers to pay their invoices, companies can sell these invoices to a third party and get money right away. This approach helps businesses maintain healthy cash flow and continue operations smoothly without being held back by slow-paying customers. Factoring is a financial transaction where a business sells its accounts receivable, which are unpaid invoices, to a third party at a discount. In exchange for selling these invoices, the business receives immediate cash. The third party, known as the factor, then collects the full payment from the customers. The discount represents the fee charged by the factor for providing this service. This is different from a loan because the business is actually selling an asset rather than borrowing money. There are three key parties involved in a factoring arrangement. First, the seller is the business that has issued invoices and needs immediate cash. Second, the factor is the financial company that purchases these invoices and provides the upfront payment. Third, the debtor is the customer who originally owed money to the seller and will now pay the factor. Understanding these roles is essential because each party has different responsibilities and expectations in the factoring process. The factoring process follows four main steps. First, the business delivers goods or services to its customer and issues an invoice with payment terms. Second, instead of waiting for payment, the business sells this invoice to a factor at a discounted rate. Third, the factor immediately provides cash to the business, typically between 80% and 90% of the invoice value. Fourth, when the payment term ends, the customer pays the full invoice amount directly to the factor. The factor then releases any remaining reserve amount to the business after deducting their fees. Let's walk through a practical example. Suppose a business has an invoice worth $100,000. The factor agrees to an advance rate of 85%, so the business immediately receives $85,000. The factor charges a factoring fee of 3%, which equals $3,000. The remaining $15,000 is held as a reserve. When the customer pays the full amount, the factor releases $12,000 to the business after deducting the $3,000 fee. In total, the business receives $97,000, sacrificing $3,000 for immediate access to cash. Factoring offers several significant benefits. It provides immediate cash flow, which is crucial for meeting urgent expenses. It doesn't create debt on the balance sheet since it's a sale of assets, not a loan. The approval process is much faster than traditional bank loans. Additionally, the factor often handles collections, saving the business time and resources. However, there are drawbacks to consider. Factoring is more expensive than traditional loans because of the discount and fees involved. The factor evaluates the creditworthiness of your customers, not just your business. It reduces your profit margins because you receive less than the full invoice amount. Finally, having a third party collect from your customers might affect those business relationships. There are two main types of factoring arrangements. Recourse factoring means the business bears the credit risk if the customer fails to pay. If the debtor doesn't pay, the business must buy back the invoice or replace it with another one. This type has lower fees and is more commonly used. Non-recourse factoring means the factor assumes the credit risk. If the customer defaults, the factor absorbs the loss, not the business. This added protection comes at a higher cost with increased fees. Businesses must weigh the trade-off between cost and risk protection when choosing between these options. Factoring is particularly useful in specific business situations. Consider factoring when you need immediate cash to meet payroll or cover urgent operational expenses. It's ideal when your customers have long payment terms, typically 30 to 90 days, and you can't wait that long for cash. Businesses experiencing rapid growth often need working capital quickly, and factoring provides that without lengthy approval processes. Finally, if your business is unable to qualify for traditional bank financing due to limited credit history or other factors, factoring offers an alternative since approval is based on your customer's creditworthiness rather than your own.
If you like this video, Hit that like button and don't forget to subscribe. Visit codelucky.com for more such useful content.